the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dived into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Markets are riding high again after a brief pullback, but was that really the correction investors had been bracing for, or is there more volatility ahead? At the same time, long-term signals are flashing bullish, and the Fed's next moves could be pivotal. So to help us make sense of it all, I'm joined by Steve Brice, Global CIO of Standard Chartered, who recently wrote a thought-provoking piece in the Business Times titled "The Equity Market Correction. Was That It?" So today we'll unpack the risks and opportunities in equities, the role of policy and seasonality, and most importantly, how investors can stay the course without getting caught up in the noise. Well, Steve, welcome back to the show.
Thank you so much. It's great to be here.
Thank you so much for joining us. Well, Steve, we've seen markets wobble a little in recent weeks, but then snap back quickly to fresh highs. Now, those kinds of moments leave many investors wondering, was that it for the correction, or should we be bracing for more volatility? So, Steve, you wrote a piece recently about the equity market correction. Do you think that the mini pullback was all we're going to get, or are risks still lurking beneath the surface?
I guess there's always risks in markets over short periods of time, but I think the risks are building again. If you think about it, since mid-April, markets have almost gone straight up. We did have, as I say, that 2 to 3% wobble a month or two ago, but it's really been pretty much straight up. So, and if you look at some of the market indicators in terms of volatility that's expected, they're signaling complacency across stocks, bonds and currencies. So these things can continue longer than you expect, but September to October is traditionally volatile, so some pullback to us is likely.
Okay. In your piece, you flagged 3 big short-term risks: crowded investor positioning, rising inflation, and seasonal volatility. 2 of those seem to have played out a little differently than expected. So how have those risks evolved since July, and which of them still keeps you up at night?
Well, I'm very fortunate is that I sleep like a baby at night most of the time, and so these things don't worry me too much. But look, if we look at the 3 of them, so investor positioning is actually less of a concern in some ways today than it was a couple of months ago. You know, from an inflation perspective, that is ticking higher. We had inflation data obviously out last night, but it's nothing too concerning, and the Fed looks willing to look through that as well. I guess the one that we're still waiting on is seasonality. So, as we mentioned, September to October, it can be challenging. We're only halfway through the first month. So that's something that we need to just watch out for. Do we see some volatility before we get through the end of October?
Right. Steve, September and October are historically tough months for equities. So do you think seasonality still matters in today's market, dominated by liquidity and policy signals?
Yeah, it's a great question, right? I guess the first thing to note is seasonality is a tendency. It's not necessarily the dominant factor. So yes, if you average out all the month over the past 20, 30 years, September and October are the weakest on average, but there's wide deviations around that. So I guess the 2 things that you can argue is if we'd seen weakness on the one hand already, then I'd probably be less worried about seasonality. It's really when you've seen very strong performance that can sometimes bite you in the bum at this time of the period. But as you mentioned in your question, Fed easing, it can be a powerful force as well. I guess the way I'd look at that is a lot is already priced. From a Fed easing perspective, we are expecting a rate cut next week and 2 more before the end of the year as well. But, as I say, that's largely priced, and inflation is going to go higher. So if we did see some negative surprise from an expectations perspective, that could lead to some short-term weakness as well.
Okay. Well, the Fed pivot toward potential easing has been a big market story as well. But you also highlight that if inflation ticks higher again, it could complicate things. So how fragile is this current market optimism? Are we one hot inflation print away from derailing the rally?
So, yeah, I guess it's a little bit fragile. It does feel that we've gone straight up for a while. I think what's interesting is there's a few things that could trigger some short-term weakness. So the first one, as you mentioned, is inflation. So we've gone past another inflation print and markets shrugged that off pretty strongly. The question is there a tipping point at some point in which that becomes more of a concern to the Fed and therefore to markets, or do they just continue to look through what they feel is a transitory inflation from import tariffs? The second thing is growth scare, and I think this one probably wasn't as much on the agenda a couple of months ago, but obviously the labour market has weakened significantly. Actually, it was a weaker starting point than previously anticipated as well, even through last year, due to downward revisions. So the labour market looks a little bit more fragile than it did a couple of months ago. And then the third thing to watch out for is the government shutdown. So there's obviously a lot of conversations that will be going on before the end of end of September, actually. So that's something that we need to keep an eye on as well.
Definitely. Well, you also pointed to bond market volatility being at multi-year lows. What is the bond market telling us about risk that equity investors might be ignoring?
Yeah, so I think we've really seen the yield curve steepen quite a lot. Basically, that is indicating several things going on. The first thing, obviously, it's the yield curve has shifted down. So short-term yields have come down sharper than long-term yields, and that's just indicative of the Fed rate cuts that are expected. Whereas we still had reasonably strong growth until now and relatively slightly rising inflation. So that's led to that yield curve steepening. Actually, in the past week or so, we've seen the curve flatten a little bit. So long-term yields fall quite significantly on these growth concerns, we think. So I think there's quite a lot going on that we need to watch out for. And obviously Fed independence, that story is still going on as well in terms of trying to remove the Fed chairperson for one, and obviously one of the board governors as well. So a lot going on at the moment. So I think, the trend for curve steepening, we think, is the trend to go with unless we see a really strong growth scare going forward.
Well, despite near-term risks, you sound more bullish over the long term here, Steve, citing stronger macro data and earnings momentum. So what are the biggest drivers behind your more constructive long-term outlook?
Yeah, I guess the first thing is we don't see a hard landing in the global economy or the US economy. Actually, I was looking through a lot of the data today. We have our investment committee next week, and it's amazing how robust most of the data outside the US labor market is. So we don't see a hard landing. That's obviously very important. If we did see a recession, we think it would be quite shallow in nature. This is not a balance sheet recession. If we did see a slowdown, we'd get strong policy support, and we're already seeing some of that. So I reckon that's the key driver for us remaining. We're only slightly overweight equities, but we have an overweight equity allocation in our portfolios today.
Okay. And then do you think equity markets are now in a position to climb a so-called wall of worry, or are valuations too stretched to sustain a durable bull market?
So usually markets climb a wall of worry after a period of weakness, and then people think the world is going to do really badly, and people, the worries just get ticked off as being less of a concern going forward. But I think the valuations point you raised is really important. So the way that we're dealing with this is we've been trimming our US allocation as we've gone through this year. So, obviously US has been outperforming for the vast majority of the past 15 years, and we feel that may be coming to an end now. So we believe that we should be allocating more to the rest of the world equities, so outside or non-US equities, with a particular focus on Asia ex-Japan equities. And we're actually seeing some signs that Asia ex-Japan is again starting to outperform. It outperformed earlier in the year, and it looks like it's now starting a trend higher as well relative to global equities. So that's where we have an overweight allocation to Asia ex-Japan equities today.
And one of your big themes in your piece is that most investors get tripped up not by markets themselves, but by their own behavior, selling when headlines are scary, sitting out rallies, or trying to time the market. It's not recommended, but, we end up doing that. So why is it so hard for even seasoned investors to step in when markets, so-called go on sale?
It's very simple. We're not clear-headed, rational beings. And generally, we have a greater affiliation to negative news. So we overweight negative news in our thinking. And part of this is because when something negative happens, it seems immediate and sharp and a surprise, whereas good things generally happen over long periods of time. So I think when markets are down, everybody's explaining why markets are down. That means there's a lot of negative news in the media. Then we overweight that rather than stepping back and saying, this too shall pass. And so that's why it is really difficult to do that.
This too shall pass. I haven't heard that in a long time. But you suggest a nuanced approach as well, Steve, scaling back slightly when things look frothy, but keeping dry powder for, pullbacks. Can you explain how, investors can apply this in practice without overcomplicating their plans?
Yeah, I think the starting point, for me would be you should continue investing almost regardless of what your view is on markets, because it is so difficult to time. But that doesn't mean you can still play around at the edges. So let's say if you have $100 to invest every month or $1,000 to invest every month, but you're worried that markets are getting a bit frothy, maybe you could pull back a bit and just invest slightly less, whether it's 80% of that or 60% of that. So you're still investing because markets can, climb the wall of worry and go up for longer than you anticipate. That just hedges your emotional aspect to the game because you're basically saying, okay, if markets continue to go higher, at least I invested. Whereas if they pull back, I still have some drive to add as markets go on sale. So I think that's the sort of best way to do it. The key thing for that is that the money that you don't invest that you normally would, you segregate that ideally physically in a different account or at least somewhere that that's been saved for when markets go on sale. So then it's there to be deployed and you don't just go out and spend it. But that's a way that maybe you can manage your emotions through the cycle.
Some great advice there. Well, your piece also ends on a very important note that equities tend to rise more often than they fall. And betting against that is risky. So if you had to give one simple, timeless rule for listeners trying to build long-term wealth in today's uncertain environment, what would it be?
I think the starting point for me is think 10 years into the future. So for me, I think, what would Steve Brice in 10 years wish Steve Brice had done today? And the first answer is stay invested. And then the second one is to add to your investments, right? So now obviously Steve Brice tomorrow might regret this, but Steve Brice in 10 years is highly unlikely to regret it at all and be very happy that you've done that. So just try and step back and think in 10 years' time what you do today and what will be the outcome of that.
I guess we got to think, what would Steve Brice do? Well, thank you so much, Steve, for joining us today.
Thank you so much, Hongbin.
Thank you. Care. That was Steve Brice, Global CIO of Standard Chartered. If today's conversation resonated with you, do check out the full article on this topic. It's titled The Equity Market Correction. Was that it? It's written by Steve himself, and it's now available at the Business Times. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.